All right, well, welcome to the Stock Market Review. And today, of course, is February 14th, 2024. Great to have everybody here. All right, so markets pulled back, obviously, yesterday on the news that maybe inflation isn't as tame as they thought. And of course, that may mean not as many interest rate cuts, if any, coming up in the near term. They still think there's probably one of them on the table for May. I think March is out, but we will certainly see. Anyway, I think we may be getting a pullback now into that target zone that we've been talking about now for a couple of weeks. So we're going to take a look at those charts. Hope everybody's having a great weekend and happy Valentine's Day. Don't forget the best trade today is make sure you say happy Valentine's and take care of your spouse, right? All right, so let's roll over and start taking a look at the charts here. I'm going to go through a few administrational items first. And of course, that includes the risks involved in trading. Like I always say, without those risks, there is no opportunity. So the two really go hand in hand. You need to be aware of the risks. Check with your financial advisor or whoever manages your money to be sure any of the ideas or maybe some of the stocks or ETFs we talk about and recommend are suitable for you. We don't know your personal situation. They do. So they need to make the final pass on that. Also, too, always trade with money you can afford to risk, called risk capital. Really important. Know how to control your risk. We can help you with that. I got a couple books on that. I've got two on money management, one called The Trader's Money Management System and the other Money Management for Traders, both excellent books. Book on the far left, the white one, is a deep dive into risk control and money management, whereas the book on the right we came out with a year or so ago, and that deals specifically with implementing a solid risk control program into your current trading, regardless of your style and regardless of the markets you trade. If you're a day trader, position trader, or if you trade forex, or if you trade bonds, commodities, whatever, stocks, you can follow the techniques in that book to implement right away a good solid risk control. And it's not hard, guys. It's really not, and you should be doing it. All right, Survival Guide for Traders is out there, has been for a while. Elliott Wave Techniques Simplified, published by McGraw-Hill, is out there. My new book, The Art of Trading, coming out this year, published by Wiley. It's going to be a good book, probably around 400 pages, and we're putting the final touches on that now. So those are available. You can go to our website and order that. You can pre-order it right now at a good price, and I'll put the links up in the recording down below. All right, we're going to start out today with Wednesday. A few economic announcements we're going to cover today. First one, of course, is NBA mortgage apps. These are all Eastern time, so it's 7 a.m. Eastern time. Got a couple speakers, petroleum status report, but no FOMC. So sit back, relax. You can day trade all day without having to worry about that. All right, Thursday, February 15th, usually the busiest day of the week in terms of economic announcements. So we got jobless claims coming out at 8:30, retail sales. Philadelphia Fed Manufacturing Index, Empire State Manufacturing Index, import and export prices, industrial production. See, I told you it was a big day. And business inventories and housing market index, EA natural gas report. Speaker, let's see what else we got. We got Fed balance sheet, Treasury, international capital. All right, I'd say that's a pretty busy day. All right, Friday, February 16th, we end the week with housing starts and permits, PPI final demand, and we got consumer sentiment and the Baker Hughes rig count. All right, so nothing about interest rates this week. How the economy is doing. We'll take a look at jobless claims tomorrow. Inflation is still there, and that's what caused the jitter in the market yesterday, of course. So we'll keep an eye on that. Basically, the market's afraid that the rates now, they priced in Nirvana. They priced in like 6 rate cuts and things of that nature. That ain't going to happen. And I think that's what is upsetting the market currently. All right, when we look at charts, we're going to be using software I created over my last 30 years. That's right, 30 years of trading the financial markets. And this is the software that I find, basically, I've almost used every piece of software out there and have tested all the different forms of technical analysis. And this software here that I came up with is basically a culmination of what I found works best in the market overall. And so we have charting software, we have scanners, we have risk control software. So we try to leave no rock unturned, so to speak, because you can't have a good trading system without a way to find stocks, all right? So you need the scanners. You can't have a good trading system without applying good risk control. So we have risk control software. So we really try to cover the gamut on what you need to be successful in terms of software tools. All right, let's take a look and dive into the latest chart on the Dow Jones Industrial Average. Well, we certainly are working its way up to that wave 5 target zone. So basically right here, looks to us like we had now a wave 3 top in 2022. So this goes back to 2022. Then we had a multi-year correction, all right, that ended here. And since then now we're moving back up, took out the old time high, and now it looks like we're in a wave 5 heading to the target zone. But you know, you're not going to go right to the target zone. At least I don't think you will. Anything's possible. But usually what happens is you'll have a big move up like we've had since October. All right. Now it's due for a little profit taking. So the market takes a break. People, you know, maybe swing traded this move up, taking profits, and so forth and so on. All right. And, you know, some news can create the catalyst for the profit taking, like the inflation, CPI numbers, right? So basically the market's coming down, should come down. I'll have a target zone for you in just a minute on the next chart, but then should recover after this and head back up to the wave 5 target zone. Now there's many people out there that are on YouTube thinking we're going to do this right away. I think it's premature to say that. All right. Could that happen? Yes. But you know, as technical traders, what we do is follow the market and we look for price patterns. That's our deal, right? So the idea behind that is if it does this, you're not going to miss it, but it hasn't hit the target zone. And so this is a fib target zone up here. And this is a 70% accuracy rate, meaning that normally 70% of the time, the way in which we draw the fib extensions and so forth, they reach those target zones. So that target zone for us, based on this, is 40,281 up to 47,426. So that's the spread. So it could end quicker or it could remain in the target zone for a little while. We don't have that kind of crystal ball, all right? But when we get into the target zone, we start becoming aware that we're there. And of course, that means after that wave 5 on an Elliott wave, that's an Elliott wave number, by the way. The wave 5 indicates the end of the trend. There are 5 waves in a trend. So then we got to be careful about a big sell-off. So I don't think we're heading into the big one yet, okay, the big sell-off yet. I don't think this is in store right now. If it happens, I'll let you know. But I do think we're going to come down a ways here, maybe for a month or so, and then see if we see some stability coming back in and go back up. So we may see some buying the dips here if we go down. So I'm not thinking we're going to get into that wave 5 target zone probably until the end of this year, but I'll let you know, okay? Now, if by chance things deteriorate and they do come down here, then when we clear this level here, all right, we know we got a problem. So we're going to give this thing quite a bit of leeway to allow for profit taking before we can declare that we have a problem in terms of the trend ending. 15% of the time, you do get a failed wave 5, okay? So it's always a possibility that that could happen, but it's not a probability, okay? That's the difference. Now, what do? Okay, are you gonna, sell stocks here because you don't have that much further to go? Okay, well, that's one strategy, and there's some prominent people saying to do that, all right? Again, because we're technical analysts and we look for price patterns, we stay with the trend for as long as possible, all right? And get out when the trend changes. And I think that's a better strategy than to just try to throw darts and guess when it's time to get out, okay? So that's my recommendation. Talk to your financial advisor, and you can certainly discuss what is going to happen with that. All right, now the next chart is going to show the actual area I think we could correct down to, and it's certain. We're going to look at the live charts in a minute, but it certainly seems like we're heading down to this area here. So basically, since this was done on Sunday, so since then, of course, we had a tough beginning of the week, so we're heading down. So the profit-taking zone, and this is a regular fib retracement. So again, the way we draw them, it comes out to about a 70% probability area. and that's between 35,726 to 36,902. So that's kind of the area where we're thinking we're coming down. We're around 38,667 going into the week. All right, so, you know, not a disaster, but a couple thousand points, and it could take a little while to get down there. But once it gets down there, all right, we should start to see some buying and then look for a new trend to the upside. So that would take it up to a final leg here, all right, that type of thing. And that 5 will be the end of the other 5 because there are 5 waves inside pulse of waves. So you have 5 inside 5. So when you get to 5 here, you'll get to the 5 on the daily. All right, so that's kind of what I'm thinking. So I don't see the big one yet. I wouldn't panic right now, but I would certainly consider, if you've been in trades since October or November of last year and you've ridden up this beautiful wave up, you may want to take some money off the table or exit those swing trades. I'm going to leave that up to you and your financial advisor to make that decision, but that's a possibility. If you want to keep the position on and not have a tax implication or whatever the reason would be, then you have to put your stop under this profit-taking area, okay, if you want to stay in for it for the long haul. I'm going to leave that up to you. All right, I would play that a certain way, but it may not be the way in which you want to play it, okay? So keep that in mind. All right, so now the next chart is going to be a long-term chart, which I did update, by the way, on Sunday. And the target zone for the top, this is a weekly chart, so every price bar represents a week. So basically, this was our pullback that we had, and so we're in the last hook up into the wave 3 target zone. So this is a wave 3 on the weekly. This is a wave 3. So this is the 3 from the daily here, the minor 4 from the daily, and when we get to here, this will be the minor 5, and it has the same target zone as the major 3 on the weekly. So then once we get up here, then we are got to get ready for a major change in trend, okay? And that would be a wave 4. And then we'll have to redraw the fibs once we see a top in place to get an idea on where that major 4 will be. And that major 4 on the daily chart will be a new 5-wave trend sequence for A, and then you'll have B and then C. So there's 5 waves in A and 5 in C for all you Elliott wave technicians out there. But that's going to be a long-term multi-year correction. And I'm thinking maybe that will start, and I'm guessing at this point, sometime in the latter half of 2024. And if, you know, things stay a little more bullish, we could bleed over into 2025. So here's my deal here, my forecast. I do think we're due for a pullback that could last a month or so, as I showed you before. After that, we'll have to see if there's some buying that comes in, and it should, if my forecast is correct. And then it should work its way back up to these target zones, wave 5 on the daily, wave 3 on the weekly. After we get to the wave 3 and we see some bearishness coming in, then we're going to have a multi-year bear market. And it's going to be a bad one, okay? It's going to really come down quite a bit, probably 40, 50%, maybe 61.8%. So I don't, you know, when we get to that top, I'll have a more accurate number on where I think it's going to go. So that's my forecast. If we take out this little bottom here, let me just get rid of all this so you can see. If we take out this bottom here, then we may have a wave, failed wave 5 and failed wave 3, but I don't think that's going to happen, all right, from a probability level. But if it does, then we'll have to switch hats to a more bearish stance and then keep an eye on this minor 4. Now, one thing that happened since the last chart that I need to bring up is now we have the PTF green here, okay, at the bottom. So basically, that's probably going to stay green until we get into that target zone, perhaps, okay? And we'll see what happens with that. I'll take a look at it next week, maybe the highs earlier, and then the sell-off will create it back to a yellow. I'm not sure, but I'll have to take a look at it. In fact, we'll take a look at it in just a moment. But in any case, that is kind of supporting the situation that we're still heading up to the target zone. All right, so that is the long-term chart, and what a run we've had even since 2009, right? So we've got one more leg up. Now, what's interesting is we're starting to get this little ass hook. All right, remember my hooks? All right, so that's the deal. Okay, you got the hook there. Actually, let me draw it like this. Okay, so that's the hook, and here's my famous shark, right? All right, coming to eat the profits at the hook. So that is also supportive of this. Perhaps we're getting into an area where we could see some type of move down at some point. Okay. So anyway, that's what I'm thinking. If you have any questions, feel free to ask, of course. All right. Now here's the S&P 500 again, working its way up. It took out its high as we expected it to, but that's due for a pullback too. All right. So that's going to mimic the Dow. NASDAQ too is due for a pullback. It's reaching a couple short-term targets. So we expect that one to pull back. That has not, as of last week, that had not taken out its all-time high. So we expect that to do it, but it may have to wait for the next leg up. All right, so that covers those major markets. All right, now I want to switch to the housing market for just a moment. And I know, I use this chart every week, but I do update it. So this is the Case-Shiller index versus the CPI, and this is the Case-Shiller here in red, and the CPI here. And the CPI measures inflation, it's the consumer price index, whereas the Case-Shiller measures on this chart the average price of residential real estate in the United States, not commercial. All right, so basically what you want to see is you want to see real estate as a hedge against inflation move up along with the CPI and stay slightly above it. The problem is when the CP or the CS gets dramatically away from the CPI. This occurred in 2008. All right. And that usually indicates some form of bubble. Just like you get bubbles in the stock market, you can get bubbles in the housing market as well. And the interesting thing about this bubble, if we take a look at the top of this bubble and come down and take a look at the dates here, pardon my straight line here, but you get the idea. Okay, it's roughly around 2008, popped around 2005 to about 2008 and then started heading down. So that remained in that upper area for 3 years, just about. So bubbles can remain bubbled for quite some time. All right, so don't forget that. So just because you reach this extenuated situation here, all right, it usually takes some catalyst or something for the bubble to eventually break, change in the mood, so to speak. And it could be a variety of reasons: interest rates, just economics in general, recessions, war, who knows, okay? But that there's something that comes in that causes that break. And so when you see this, you know that this is probably it's not sustainable, so to speak. And you have to realize you'll probably get some type of pullback. And of course, that's what we got in the financial crisis. What was interesting, though, is it didn't pull back as close as it was back here. So housing still remained a pretty good hedge against inflation. And then we saw a rebound after all the bad loans and everything got washed out. Interest rates were pretty low, remained low. COVID came, interest rates went down. The government pumped some money into the system as well. And people moved from the big cities to the suburbs. So the housing increased. And now we've got another bubble here, which is quite interesting and double what it was in 2008. So that's concerning, and that should concern everybody here. Now notice that inflation, measured by the CPI down here, also increased as inflation increased around the world and, of course, in the United States. And so, but housing also went up. And so it's still bubbled, and you still have the same distance away. Well, it's actually further away now than it was when the inflation started. So if you believe in history, and if you believe in the fact that markets tend to correct and come back after bubbles, then you have to acknowledge that we're due for a correction in the real estate market. And that correction probably get down to some type of level that makes sense. Could be 40%, maybe 50 at some point. Now, some people will say it's happening now, it's coming down. Okay. I haven't seen that yet, really. I've seen sales really come down, but housing has remained fairly pricey in most parts of the country, and it's very local, so it may not be in your area. But I can tell you in California, they're still up there. In my area here in Arizona, they're still up there. But sales are not as plentiful as before. That's for sure. And the fact that interest rates may not be coming down as much as anticipated may make it that people are basically not going to be buying as well. So you won't have as much volume in sales. Now, what could happen, however, you're getting a lot of layoffs in the country. And, a depression or a recession is not a recession or a depression until it hits your house, right? All right. So if you get laid off, if people get laid off, they're going to have to probably liquidate their home. They don't have another job. And so even though they got that nice, cushy, low interest rate, that may increase the supply a bit. And prices were going to have to come down because if interest rates will stay probably right around here, and some of the other charts I'm going to show you, the income levels aren't high enough to buy these homes right now. So something's got to give, right? So that's kind of where we're at. So that is the Case-Shiller index versus the CPI indicating a bubble. Now, the next chart, let me just enlarge this a little bit so you can see this better, comes from RE Venture Consulting. And they've done a great job with this chart, and I want to give them credit when credit's due. And this is the home value to income ratio. Now, this was done back in the summer of 2023. So they'll probably update this in a few more months or so, or during the summer. But at the time this chart or this table was created, home prices were 31% overvalued compared to income levels in America. I think it's even worse now. All right, I'd say it's probably more like 40. But the idea behind this chart is every time you see the line or the oscillating line start to turn red in color, you're getting into a bubble situation. So this was 2008, which was pretty bad, right? But look at it now. Okay, it's even worse now. So right now, we're much more overvalued in housing than we were in 2008 compared to income levels, according to this. All right, so that's also indicating a bubble. So you got a couple different charts here, or graphs, looking at different variables, but both indicating a bubble in the housing market. Okay, so we got to pay attention to that. And certainly with real estate, you got to live someplace, right? So rents have been going up as well, but you got to live someplace. And the idea is with real estate, if you're probably sitting on something that you've owned for a long time, if you have debt against that property and you're worried about an inflation or the market coming down and taking equity out of your home, again, talk to your financial advisor, but it may be wise for you to sell that home, take the equity, and roll it into another home of lower value, maybe a different area, and get rid of the debt, right? Because the debt income ratios are pretty high here as well. All right, so again, you need to think that through, but this brings us to the debt to income ratio for all home buyers, again, by RE Venture Consulting. And we're again at a housing bubble. All right. So home buyer debt to income ratio is averaging close now to 40%. And that was in 2023. It's worse now. Those are the worst affordability levels on record, according to the FHFA and the calculations they did at RE Venture. And that's even worse than the 2006 to 2007 bubble before the last crash. So I think when you look at these, you cannot argue that we are in a bubble at this particular point. The question is, when is the bubble going to burst? And like I showed you before, bubbles can last a while. But make no mistake about it, the probabilities are indicating the bubble should burst. All right. A lot of times you hear things like times are different now. When you start hearing that, run for the door, because times are not different. Okay. Technology may be different. The reasons for the bubble may be different. But a bubble is a bubble. Okay, so don't forget that. All right, so I think that's important to cover when we talk about the markets today, because I think real estate's on everybody's mind. And you have to kind of look at the big picture of not only equity stocks, but of real estate as well. All right, so I kind of wanted to cover that. And now I want to go over to actual charts here. And here is the chart of the Dow Jones Industrial Average. So I have that short-term 60-minute chart over here, daily for the intermediate look, and the weekly for that long-term look. So this is basically the same symbol across 3 time frames. And let's open up this daily one to start and bring this over here where we can see it much better. All right, and you can see the pullback that we had yesterday. There you go. All right, so let's give that a second to load. So here's the drop yesterday. Now, what's interesting here, do you see this price bar? In terms of technical analysis, that's called an inside price bar. So I'll put IP for inside price bar. When you see that, if that price bar remains inside today, then what happens in the remainder of either tomorrow or the rest of the week, whichever way the market breaks above either the high or low of that inside price bar, statistically, not guaranteed, but statistically, in terms of probability, you get 2 to 5 price bars of movement in the direction of the break. So if we break below it, that means we're probably going lower. If we break above it, we may go back to the upside. Now, what's also important here is our system, our software tools identified a greed bar here. And what that greed bar is this indicator at the bottom called the emotional reader index, which measures fear and greed. So if we get below that, which we did, it usually is an indication we're going to come back into a more orderly position in relation to the trend line. That's what that usually means. And so we've gotten further away from that trend line. Now notice too, we also have the infamous hook, right? So we've got the hook here too. So we're kind of due for a pullback here. Could we make one more high? Always possible. All right, we might make one more high here and then it comes back down. But we're going to watch and see which way the market breaks out of this inside price bar, which is why I'm bringing this up at this point. We have bearish divergence in our owl, indicating we're due, but bearish divergence, like a bubble, can last a while, right? So we don't use that alone, but it's certainly showing a mature trend. All right, now let's go take a look at the short-term time frame and bring this up. All right, and for right now, I'm going to just, at this particular point, let me just remove, let's do this. Let's see what we got here. Okay, I'm going to keep, I think I'm going to remove this one because this is the long-term one. I don't want it on this chart, so let's just keep that one. All right, so this one here is the one I showed you from I did Sunday, which is where we think the pullback, and as you can see, it's starting to move in that direction. And now we have a red owl, so you need to have that owl turning red before you can consider this into a pullback scenario. And we have a red PTF. So we have a situation now where this has a high probability of being taken out. So that would indicate we're on our way probably to that correction zone. Okay, that's the way I would look at that. So again, we think probably around 36,400 to 34,831. Okay, so we should be getting down into that area there. So that's kind of where we're at now. All right, so I'm done with the half an hour. That's kind of what I wanted to cover today. Now, if you have individual stocks, please come to Stock Analysis Friday. That's on Fridays where I can look basically any stock that you would like me to up in that area. That's the purpose of that. So we don't shortchange people on helping them out with some of their stocks. This is primarily for the market update, market forecast, and things of that nature. So bring your stocks back then and we'll take a look at those. So again, probably in a short-term pullback, how long is it going to take to get to the pullback area? we'll have to wait and see when we get, start breaking down a little further. But you got to probably give it a month or so, maybe a little less. Depends how fast it moves. And then we should see some type of recovery and an opportunity to buy the dip and a move back up. So I think we're good for a little while longer. I'm not, crying wolf right now, but I'll probably be crying wolf more towards the end of the year, I would think. All right. So I want to thank everybody for being here. And I appreciate you taking the time. I know you're busy. Everybody's busy taking the time today to join us. We did record the session. The recording will be up for you to look at if you ever miss the live sessions. But have a great day. All right. And, if you take some profits, check with your financial advisor to be sure that's something that you should be doing. And we'll see you back here next week. Okay. Thanks, everybody. Have a good one. I'll put some music on and then we'll call it a day here.